In today's video, let us understand statistical hypothesis testing for financial model validation. In quantitative finance, the development of predictive models is often the primary focus. However, a prediction, no matter how sophisticated its generating algorithm is, it is merely a proposition. The critical subsequent step is to determine whether the model's observed performance, its accuracy, or its outperformance related to a benchmark is a genuine reflection of its efficacy or simply a product of a random chance. This is the domain of statistical inference, and its principal tool is hypothesis testing. Hypothesis testing provides a systematic, rigorous framework for making decisions based on the sample data in a world where population parameters are inherently unknown and unknowable. While a machine learning model might predict that a stock will rise, a hypothesis test is used to validate a broader claim, such as is the mean return of the trading strategy derived from this model significantly greater than zero after accounting for costs. It moves the analyst from observation to conclusion, providing a structured methodology, assess the power of predictions and the viability of financial strategies. By quantifying the statistical significance of an observed outcome, hypothesis testing serves as a foundational element of risk management, enabling analysts to differentiate between a true edge and a market noise. The entire edifice of hypothesis testing is built upon the dialect between two competing, mutually exclusive statements about a population: the null hypothesis and the alternative hypothesis. The null hypothesis, denoted by H naught, represents the default position or the status quo or the hypothesis of no effect. It is a statement that any observed pattern in the data is due to a random variation. In financial modeling, the null hypothesis is typically formulated as the statement one wishes to disapprove, one wishes to disprove. For instance, when comparing a new trading strategy A to an established benchmark strategy B, the null hypothesis can be the following. The first example will be the mean return of strategy A is equal to the mean return of strategy B, which can be shown by this. The second null hypothesis will be the mean return of a strategy is not positive. And the third example of a null hypothesis can be the Sharpe ratio of A is equal to the Sharpe ratio of B. The null hypothesis is assumed to be true unless the sample data provides a sufficient evidence to reject it in favor of an alternative. Now, the alternative hypothesis, denoted by HA or H1, is the logical opposite of the null hypothesis. It is the proposition that the analyst seeks to support the claim that an effect or a difference exists. Rejecting the null hypothesis leads to the acceptance of the alternative. So the examples corresponding to the nulls above would be mu of A is not equal to mu of B, will correspond to the first null hypothesis UA is equal to mu B. And mu is greater than zero corresponds to the second null hypothesis of mu less than or equal to zero. The Sharpe of A is not equal to Sharpe of B corresponds to the third null hypothesis of Sharpe A is equal to Sharpe B. The formulation of the alternative hypothesis also determines whether the test is one-tailed or two-tailed. A two-tailed test investigates a difference in either direction, which is appropriate when the analyst has no prior expectation about which strategy might be superior. A one-tailed test is a more specific and powerful and used when there is a strong directional theory. The choice between them must be made before data is collected to maintain the analytical integrity. To decide between the null and alternative hypothesis, a test statistic is calculated from the sample data. This value standardizes the observed difference between the sample statistic and the value expected under the null hypothesis, scaling it by the standard error of the sample statistic. The general formula for a test statistic is the sample statistic minus the hypothesized population parameter by the standard error of the sample statistic. Sometimes the standard error of the sample statistic is typically sometimes equal to the standard deviation by n, or the sample size. The statistic follows a known probability distribution, which allows for the calculation of the p-value. The p-value is one of the most crucial and frequently misinterpreted concepts in statistics. The p-value is the probability of observing a test statistic at least as extreme as the one computed from the sample data, under the assumption that the null hypothesis is true. It is not the probability that the null hypothesis is true. A small p-value indicates that the observed data is highly unlikely if the null hypothesis were true. This low probability provides strong evidence against the null hypothesis, leading the analyst to reject it in the favor of the alternative. Conversely, a large p-value suggests that the observed data is consistent with the null hypothesis, and thus there is insufficient evidence to reject it. Since decisions are based on probabilistic sample data, there is always a risk of drawing an incorrect conclusion. Hypothesis testing formalizes the management of the risk through two types of errors: The first type, or type 1 error, is rejecting a true null hypothesis. This is also called a false positive. For example, this can be something like concluding that a trading strategy has a positive mean return when it really does not. The probability of committing a type 1 error is denoted by the Greek letter alpha, also known as the significance level of the test. Now, the next type of error, or the type 2 error, is a failure to reject a false null hypothesis. This is a false negative, like failing to identify a genuinely profitable strategy. The probability of a type 2 error is denoted by beta. The analyst must specify the significance level alpha before conducting the test. This value serves as the threshold for decision making. If the conducted p-value is less than or equal to alpha, the null hypothesis is rejected. Conventional choices for alpha are 0.10, 0.05, and 0.01, representing a 10%, 5%, and 1% risk of type 1 error. There is an inherent trade-off between these two errors. Decreasing alpha to reduce the risk of type 1 error necessarily increases the risk of type 2 error, beta. The only way to reduce both simultaneously is to increase the sample size. The complement of beta, which is 1 minus beta, is known as the power of the test. It represents the probability of correctly rejecting a false null hypothesis, that is, correctly identifying a real effect. A test with higher power is more desirable. The selection of alpha is not merely a statistical convention. It is a critical risk management decision. In finance, the consequence of a type 1 error, deploying capital to a strategy that is believed to be profitable but is not, can be catastrophic, leading to direct financial losses from transaction costs and underperformance. This justifies the use of stringent significance levels such as 0.01 to minimize the probability of such false positive. Therefore, the hypothesis testing framework serves as a formalized process for managing decision-making risk, where alpha is direct quantification of the firm's tolerance for the specific costly error. The validity of any statistical test is contingent upon its underlying assumptions. Applying a test without first verifying these assumptions can lead to invalid conclusions, regardless of the sophisticated analysis. For financial data, which is predominantly in the form of time series, two properties are of paramount importance: normality and stationary. Rigorous examination of these characteristics is a non-negotiable prerequisite for a sound statistical inference. The normal distribution is a cornerstone assumption for a vast array of parametric statistical tests, including the t-test, and for many foundational financial models, such as the Black-Scholes option pricing model. However, the empirical reality is that financial asset returns frequently deviate from the normality. They are often categorized by leptokurtosis, meaning that extreme events occur more frequently than what a normal distribution predicts, and skewness, where the distribution is not symmetric around its mean. Given this divergence between theory and reality, formally testing for normality is a critical step. The Shapiro-Wilk test is a powerful and widely accepted method for this purpose, particularly effective for smaller to moderate sample sizes. The hypotheses for the Shapiro-Wilk tests are H0 is equal to the sample data is drawn from a normal distribution, and H1 is equal to the sample data is not drawn from a normal distribution. A low p-value for this test provides evidence to reject the null hypothesis, suggesting that the data is not normally distributed and the parametric test assuming normality may be inappropriate. Now, this code is a sample example of the Shapiro-Wilk test. First, we import the necessary libraries such as NumPy and Shapiro from the scipy.stats. Then, we set a random seed so that the results are reproducible. Then we generate 250 synthetic returns from a normal distribution with mean of 0.1 and standard deviation of 2%. Then we also generate 250 synthetic fat-tailed returns and scale it with 0.02 to match with that of the normal deviation, and shift the mean by adding 0.001 to match the normal sample. So now the both data sets have similar mean and variance, but one has fat tails. Now we calculate the Shapiro-Wilk statistics for each of the datasets. This returns the test statistic and the p-value for the normal distribution, and this returns the test and p-value for the fat tail. Now, since the p-value is greater than 0.05, we fail to reject the H0 because data appears normal. And since the fat tail returns p-value is equal to 0.00, we reject H0 and data is not normal. Now let's look into stationarity. Stationarity is a fundamental property of a time series. A series is stationary if its statistical properties, specifically its mean, variance, autocorrelation structure, do not change over time. Most financial prices are non-stationary. They exhibit clear trends, and the mean value is time-dependent. In contrast, daily or weekly returns of an asset are often stationary. The importance of stationarity cannot be overstated. Applying standard regression or other forecasting models to a non-stationary data, spurious regressions, where a statistically significant relationship is detected between two variables that are in reality unrelated. The statistical signature of non-stationarity is the presence of a unit root. The industry standard for detecting a unit root is the augmented Dickey-Fuller method. The ADF test is a formal hypothesis test with the following structure. H naught is that the time series has a unit root, and HA is the time series is stationary. To conclude that a series is stationary, the ADF test must produce a result that allows for the rejection of the null hypothesis. This occurs when the calculated ADF test statistic is more negative than the critical values at a chosen significance level, or equivalently when the p-value is below the significance level. So now let's look at this example to understand stationarity. First, we import the pandas library, and from the stats models.tsa.stat tools, we import the add fuller method. We generate a random walk. A random walk symbolizes the walk of a stock price, which is random and non-stationary. And after this, we generate a stationary series also using the np.random.random. Then we perform the ADF test on the non-stationary series or the random walk, where we get a ADF statistic of minus 1.4986 and a p-value of 0.5342. Now, since the p-value is greater than 0.005, which is a test statistic, we fail to reject H naught, which means that the series is non-stationary because it has a unit root. Now, after this, we perform the ADF test for the stationary series. We get an ADF statistic of minus 22.4976 and a p-value of 0.00000. So, since the p-value is less than 0.05, which is a test statistic, we reject H naught, meaning that there is no unit root and the series is stationary. From this, we can infer that using the add fuller method, we can correctly recognize if a series is stationary or not stationary. The diagnostic tests for normality and stationarity are not merely a checklist of independent procedures. They form a crucial ordered sequence that dictates the entire subsequent analytical path. This sequence can be understood as a decision tree. An analyst seeking to compare two strategies must first ensure that the time series of returns for each strategy is stationary. Comparing the means of two non-stationary series is statistically invalid because the concept of a constant mean does not exist for such series. Any calculated mean is simply an artifact of the sample period. Therefore, the ADF test acts as the first gatekeeper. If a written series is found to be non-stationary, it must be transformed until stationarity is achieved before any comparative analysis can be proceeded. So this creates a rigorous procedural hierarchy. First is that we ensure stationarity, then we check for the normality, and then we select and perform the comparative test. Now, let us look into A-B testing for competing financial strategies. The concept of A-B testing prevalent in web optimization and product development translates directly and powerfully to the domain of quantitative finance. In this context, it serves as a structured experiment to compare two competing trading strategies. Strategy A can be considered the control group. This might be an existing model in the production, a simple buy and hold strategy on a benchmark index with, like the S&P 500, or any other baseline for comparison. Strategy B is a challenger, a new model, or a variation of an existing one that is hypothesized to be superior. The primary goal of A-B test is to determine whether the observed difference in performance between two strategies is statistically significant or if it could have plausibly arisen from the random market fluctuations. To structure this comparison as a formal hypothesis test, the analyst must define the key variables. The dependent variable is a performance metric of interest, most commonly the mean of the daily or weekly returns distribution. But it could also be another metric like the Sharpe ratio. The independent variable is categorical and has two levels, strategy A and strategy B. The null hypothesis is typically that the mean performance of two strategies is equal, and the alternative is that they are not equal. Before applying the test, its assumptions must be verified, as established in the procedural hierarchy discussed earlier. The test we will be applying here is an independent sample t-test. It is a statistical workhouse for comparing the means of two independent unrelated groups. It is the ideal tool for A-B testing framework described above, as the returns generated by strategy A are independent of those generated by strategy B. The key assumptions for the independent t-tests are the data are continuous. Here, the returns are the data. The second assumption is that two samples are independent. The third assumption is that data between each group are approximately normally distributed. And the fourth assumption is that there is homogeneity of variance. That is, the variances of the two groups are equal in the population. Now let's get into this Python walkthrough. First, let's load the daily series for both strategies. For this example, we will use simulated data. Here, we select the random seed as 101 and we generate returns A with a mean of 0.08% and a standard deviation of 1.5% with 1000 samples. After that, we generate returns B with a mean of 0.004% and standard deviation of 1.2% and with the same sample size, which is 1000. So the mean return of strategy A is 0.001196 and the mean return of strategy B is 0.000979. Now, as per the established workflow, let's check for normality using the Shapiro-Wilk test for normality. We calculate the test statistic for each returns A and B. So the p-value for A is 0.6017, which is greater than 0.05. So we infer that returns A is normal. And the p-value for strategy B is 0.0943, which is also greater than 0.05. So we also infer that the returns B are also normal. Now we can proceed with the t-test. We use the scipy.stats.ttest.ind to perform the A-B test. It is a good practice to use equal var is equals to false to default to the more robust Wilks t-test. Here, we call the t-test ind function using the parameters returns A, returns B, and setting equal var is equals to false. And alternative is equals to two-sided because our alternative hypothesis, which is equal to the mean returns are not equal, is a two-sided test. Get the output t statistic and p-value. So the t statistic which we got is 0.3427 and the p-value which we got is 0.7319. Since the p-value is much greater than the significance level, which we took as 0.05, we failed to reject the null hypothesis. The conclusion is that despite the observed difference in the sample mean, there is no statistical significant evidence to claim that the true mean daily returns of the strategy A and strategy B are different. The observed outperformance of A over B in the sample could easily be due to a random chance. The diagnostic check here reveals that the returns are not normally distributed. The independent t-test is no longer the appropriate tool, while single t-test over an entire backtest period provides a summary judgment. It can mask important dynamics. A strategy might appear significantly better on average, but this outperformance could be concentrated in a specific market region, while it underperforms in others. This lack of consistency is a major risk. A more robust and insightful approach is to use rolling window t-tests. This technique involves applying t-tests not on the entire dataset at once, but to a moving window of a fixed size. For example, like 1 year or 1 month or something like that. The result is not a single p-value, but a time series of p-values. By plotting the series, we can analyze and visualize how the statistical significance of the performance difference between the two strategies evolves over the time. This allows for a much deeper understanding of the strategy's robustness. It can reveal periods where one strategy's edge was particularly strong and periods where it disappeared, or most critically, if a once profitable hedge has been decaying over time. This method transforms the A-B test from a statistic validation into a dynamic diagnostic tool. So, with these examples, we have understood how statistical tests are used for financial models. This disciplined scientific mindset is the most potent defense against the cloud of biases and the overwhelming role of randomness that define the financial markets. It shifts the focus from chasing the performance to validating a process, fostering the development of models that are not just historically profitable, but are also statistically robust, defensible, and more likely to succeed in the future.